Hello, everyone. I'm Alex, and I'm here with Wade. And just like they do in the Love Boat, I'd like to introduce a very special guest, a reoccurring guest, Bob French. Just think of him as the Vic Tayback of the Love Boat. Welcome, Bob.
Thanks, Alex. But I think you're dating yourself there a little bit. That's a little bit before my time.
Yeah, that's okay. I don't mind. It's a 70s sitcom, but I saw the reruns for the record.
Okay.
And in the 80s.
Yeah.
Well, the Vic Tayback one was. The Love Boat was 80s hardcore. So, yeah, I guess I am, but so be it. If that's wrong, I don't want to be right.
Yeah.
I have at least one listener who's very excited because their specific feedback to the show was that we needed more Bob French. So
that's right. It wasn't even me who wrote that one. So
yeah, more Bob, more cowbell, more Bob, that's less right. Me probably.
or you're the cowbell, one or the other. So
possibly. All right, Bob. What did we rope you in today for?
Yeah. So, with the beginning of the new year, we wanted to kind of come on and talk a little bit about kind of the year in review or the market review of 2022. We all kind of know it's not something we want to fixate on or focus too much on, year by year type of performance numbers. The exact numbers themselves, don't make. They make a big difference. Don't get me wrong. I don't want to be cavalier about that, but they're kind of something that is a little bit noisy and they're going to bounce around. But what's really important to do is kind of just keep abreast of generally what's going on. What are the stories that we should be paying attention to? What's happening out there, and how might that affect our longer term retirement investments? So that's kind of the type of stuff we want to be focused on here. And actually, before we even jump into the market review, I think it's worth calling out why we're paying attention to this type of stuff with the retirement dashboard that Wade's actually just updated here.
Mm-hmm. Yeah, that's right. Yeah, before we started recording, we were talking about things and realized we now have an episode for next week, and that's to go through the retirement income dashboard, which everyone can see. It's now updated for January 2023, and it's at retirementresearcher.com/dashboard. And it's been almost 2 years since the last time I updated it. I've been neglecting it a little bit, but it's worth an update because since the last time, interest rates are much higher, and that has a big impact on sustainable spending from investments, from bonds, from annuities. At the same time, though, with inflation being higher at this point, although I think, Bob, part of what we'll talk about today is we may have some relief on the horizon there, but at least with a higher starting point for inflation, that still creates some concern for the true inflation-adjusted spending strategy in retirement. There's a big difference now between that and just assuming a simple 2% cost of living adjustment on spending. But we'll really dig into all that next week as a follow-up and application for what Bob will be telling us today in terms of the year in review with how markets performed in 2022, as well as their recent past.
Great. And that's really the important piece here, to kind of take all of this stuff that sort of happens in the market and figure out how it impacts that longer term, which is really what a lot of that stuff on the retirement income dashboard, really, really gets at. And again, that's at retirementresearcher.com/dashboard. But as Wade said, we'll really dive into it next week and really tear it down to give you some really, really great information there.
Yeah, and check it out. I think it provides a lot of context, and the titles of the tables are fairly self-explanatory. But we'll get into that in the next one because, really today's episode is about how the markets moved while, we took a revolution around the sun. The retirement dashboard really talks about the context of all of that. So I think it's quite important.
Absolutely. But talking about how the markets moved as we went around the sun again here, let's kind of dive into some of the numbers. We're not going to go, point by point for the next half hour. But I think it is worth touching on some of the high points here. And we'll actually start off on a good note and just focus in on the fourth quarter. This fourth quarter actually was pretty darn good across the board. So, just running through a couple of the numbers, the Russell 3000 index, which is a pretty good representation, a very good representation of the totality of the U.S. stock market, that was up almost 7.2% on just the fourth quarter. The MSCI World ex-US Index, that was up almost a little over 16%, 16.2% almost. Emerging markets up 9.7%. S&P Global REIT, so kind of REITs around the world, that was up almost 6.9%. And the Bloomberg Aggregate, kind of the U.S. bond market, that was up almost 1.9% just on this past quarter. So overall, really, really solid quarter.
Couple of things with this, Bob, and this just want to point out. Real quick, we mentioned the Russell 3000, and we probably need an episode just on like indices when we get into our investment themes. But again, you can say no, the S&P 500 is representative of the market. I want to point that out because the Russell 3000, you don't see that in the tickers of CNBC and the like. It's effectively the what is investable 3,000 stocks within the entirety of the U.S. stock market.
3,000 stocks in the U.S. stock market. Where
the S&P 500 are, the 500 companies are the most representative of the U.S. economy. And so it doesn't give you the full sample. And so you can make the case that's a little more precise, the Russell 3000. And well, it is. It's not just large cap, it's the entirety of the market. Now, something that we said, to the theme of around the sun, for whatever reason, we demarcate ourselves in terms of year end, that kind of beginning of the year end. If October was January and we're doing a first quarter review and we see these returns where there's like a ticker tape parade, like, oh my goodness, look at this. What a great year we're having. Go, go, go. When the S&P, when the stock market returns positive in the first quarter, it has this % of finishing positive for the rest of the year. We think like that, right? But because this is the last quarter of what ultimately are 4 consecutive, 4 quarters where it's not so bad, we tend to view these returns as, well, you know what, it's still bad for the year, so you're less sort of sanguine about it. It's kind of a cool little, not cool, but it's an interesting thing, right, Bob? Where people are like, well, thank goodness the fourth quarter was up, because if not, it would have been a very poor year. Whereas, well, it is a poor year, but it would have been even worse. Whereas if these returns are in the first quarter, I think people's outlook is magically different because it's new year. So I just want to point that out.
And actually, to that point, it's been a little while ago, but if you remember Bill Miller, for a long time, he had this streak. I think it was Bill Miller, but for a long time, he had this streak where every year he beat the S&P 500. But that was because they were measuring it from January to December. If you shifted the start point, he was not he was doing pretty well for himself still. But
the overall returns are good. And Bob's not trying to discount that.
Massive streak he had. It's all in how we measure this type of stuff. But as Alex did point out, we do measure it by the year. And unfortunately, 2022, as good as the fourth quarter was, that's how bad 2022 was overall. Those first 3 quarters were bad enough to more than deal with a good fourth quarter. Again, just to run through the numbers, the Russell 3000 down 19.2, and to call out the S&P there, Alex, the S&P was down 18.1 over the entirety of 2022. MSCI World ex-US, so kind of developed international, that was down almost 14.3%. Emerging markets down a little more than 20%. S&P Global REIT, again, REITs around the world, down a little more than 24.3%. And
REITs, just because we don't exactly know the overall sort
REITs of REIT stands for Real Estate Investment Trust. So it's basically a diversified, but moderately, depending on which one you're talking about, diversified portfolio of property holdings. And there's some specialized kind of forum type of things about how much they have to distribute and stuff like that in terms of their income. But generally, in a diversified way, if you're looking to include kind of real estate in your portfolio, which is pretty common, that's how you would do it in kind of a broad, easily tradable type of fashion. So you don't own an apartment building in your IRA or something like that. You own a REIT, which owns a bunch of properties, a bunch of apartment buildings, either in a specific region or, across the country or whatever it might happen to be. But that brings us to, the Bloomberg aggregate. So again, the U.S. bond market. And over the entirety of 2022, it was actually down a little over 13% on the year. So bonds did not have a great year in 2022.
And Bob, just taking that a bit further, I saw that the numbers had come in for treasuries, and long-term U.S. treasuries were down a little over 26% for the year, which is the biggest of any of these numbers in terms of
absolutely loss. And that's just straight up. That's interest rates moving. That's that's what happens when interest rates move. A lot of that was driven by obviously the long-term bonds, which are going to have the most dramatic impact based on what interest rates are doing. Both, when interest rates go up, bond prices go down. But those are the things that have gone up the most when, over the past, 20, 30 years, bond or interest rates have been coming down. So that's one of the reasons that we talk about those being more volatile and kind of more risky based on those interest rate moves. So, but, one thing I do want to stress as we're talking about some of these numbers, as Alex pointed out, we're talking about kind of 1 year type of numbers. But we all kind of know that 1 year is a little bit of a drop in the bucket. Now, I don't want to minimize this. We all did just lose, depending on your allocation, call it 20% of your money over the past year. That happened. But it's always important to think about investing in that longer term kind of context. We don't invest for a year. We know that if we're going to be investing, we're going to be putting our money at risk. And this is what putting our money at risk looks like, unfortunately, every once in a while.
Yeah. And if you even think about it, when you're seeing the what's the expected return of the S&P or something like that? Yeah, I don't know the exact number right now when you look historically, but it's something like 10% return with a standard deviation of 17. Yep. Something like that. And so that means 67. A standard deviation is a measure of central tendency, and so what it's saying is that the average is 10, give or take. But just humor me here. The average is 10. Then you can expect 68% of the time it's going to be 17. Or, with a standard deviation of 17, it's going to be 27 or -7. Yep. That's a wide range, but that's what that means when you say standard deviation. And so to some extent, a -19 on the Russell 3000 is bad, but it's not, it's not unexpected because that was 67% of the time. One more standard deviation, which is with the realm of possibility, captures that.
No, and we can actually touch on that in a second, but I wanted to kind of call out that even if we extend this out to, say, 5 years, that Russell 3000 return, the 5-year annualized return ending, the end of the year, 2022, was 8.8% per year. So if you held it over 5 years, that was your holding period return, that 8.8% per year.
Think about everything that's happened.
Even with this past year, everything that's been happening. A pandemic, all of this stuff.
If someone came up to you 5 years ago and said, "Hey, look, the S&P is going to return
Russell 3000."
I'm sorry, the Russell 3000 is going to return such and such, and then I'm going to give you a choice of these things happen, these things happen, these things will happen. 3 possible things that happen. One of them is rosy, one of them is just normal, and one of them is this pandemic scenario that we just had. Who would pick the pandemic scenario as being the things that happen and still capturing these returns? I wouldn't, on a guess, I wouldn't have.
Absolutely. And then, it was a pretty typical 5-year span. And then if we go out to the past 10 years, the Russell 3000, it annualized at 12.1% per year. This has been a really, really good decade, even with everything that's been happening. So even if we start expanding this out even a little bit, because 10 years is not particularly a long-term time frame in terms of investing or retirement planning. We're still seeing really, really solid returns out there. Not just in the Russell 3000 or the U.S. stock market, but across the board. I think that's always really, really important to keep in mind as we're talking about this. And in fact, this weekend, we actually released our Occam's Razor, our kind of quarterly newsletter, where I was actually talking about what does the long term actually mean. So I'm not going to belabor the point. You guys can all either have read it or can easily go read it. But, I really want to drive that home that the long term is a lot longer than you think.
But you mean it. You mean it from the standpoint of how long do we have to, and correct me if I'm wrong.
Yeah,
I think you mean it as in how long should the expectation be to capture an expected market return,
right?
As opposed to what your advisor tells you when your portfolio is down and they say, "Oh, long term," that kind of thing.
I will admit, unfortunately, it's the right answer. It does feel like more than a bit of a dodge when the markets aren't cooperating. But you're absolutely right. We want to be thinking about what long term means in the context of, how long do we need to wait, for lack of a better term, to be able to let the fundamental risk and return relationships in the market kind of assert themselves, to come out of, or for that random walk to cancel itself out, basically. But just to put some numbers around that, looking at, and we go into this a lot more detail in the article, but, from 1926 through 2022, about 14% of rolling 15-year periods for the S&P 500 index actually lost to 5-year treasuries. So 14% of the time over any 15-year period that if you were to pick that randomly, stocks lost to bonds, and not even crazy bonds, 5-year treasuries. This is something that's normal. This is something that happens even over periods that people think of or think should be long-term, but they're not. Another way to think about it is really what we're seeing isn't all that unusual. So to put some other numbers around it, this past year was the 7th worst year for the S&P 500 since 1926. So that's 97 years total. So 7th worst out of that. But if we flip that around, what that's saying is that, we would expect a year this bad or worse once every 14 years, which is kind of about what we're seeing. Go back to 2008. So I guess that would be 13 years. But, it's, the market, this is one of those few times when the market's being kind of neat or kind of orderly, I guess if you want. But this stuff happens. And it seems to be happening about as often as we expect.
Yeah. No, it's not the 1 year drop that's to be capturing my attention. And Wade, I want you to chime in here. So you're saying the statement you said was 14% of rolling 15-year stock periods end up 15-year periods end up underperforming bonds. That means from 1926, add 15 years, and then what was the return? From 1927, add 15 years, what was the return, et cetera, et cetera. Do that until present day. So roughly 85% of the time you do, stocks outperform.
Yep.
15%, 14% it doesn't. Wait, that's just harkens back to the whole fragile decade for me and taking distributions. And I'm not saying don't do it or anything like that, but you have to be prepared to accept these consequences if you happen to be in that 14%. But Wade, what does that impact you as strong as it's impacting me? That kind of statement that Bob made?
Yeah, I mean, absolutely. It's always the context of this is retire with style. And when you're accumulating assets, like the question of what is the long term, when you're accumulating, the long term may be longer than when you're in retirement. If you have a poor market performance over those 15 years straddling your retirement date, that can create significant problems that extend well beyond those 15 years, just because you don't have the portfolio left at that point to maintain the lifestyle that you're looking for. So risk does have that bigger impact in retirement. But in a pure accumulation mindset, it's a little easier to digest the numbers that say, well, every once in a while, you'll have a 15-year period where stocks cannot outperform bonds.
Yeah, it's a little different if it's that right before you retire. We start going into one of those periods, unfortunately.
But these things are independent of each other. So if you have 50%, I'm just going to round. If you have a 15% chance, and this is your nest egg, and you're going in a strategy that's all in on that.
Yep.
That's it's almost like just caveat emptor.
Right, and again, that's purely stocks versus bonds. So
I know, but it's a bad. It's not like you went down, but it's just one of these that I'm sure if stocks underperform bonds, you're going to start contemplating, no matter what.
Oh, absolutely. But that's why people put part of their portfolio in bonds or in other, say an annuity or building out some of those other safety.
I know, but this year, congratulations, bonds are down. I hope you're feeling better.
How do you feel about that data point that ultimately it's kind of, are you safety first or are you probability based? And it's how much that data point causes any sort of concern really represents maybe which way you lean on that retirement income factor.
Absolutely. And actually on that point, with stocks and bonds being down in the same year, I've seen a lot of people talking about that because it is a little bit unusual. A lot of the times people talk about diversification as, hey, you buy all these types of things, stocks, bonds, all the different stocks out there, because, when this thing goes down, the other thing goes up. When stocks go down, bonds go up, or the other way around. We didn't particularly see that this year. So, I think it's worth kind of calling this out and putting some numbers around this and helping people think through this, because I've seen a lot of people out there talking about how this is, obviously 1 year of data, but proving that, diversification is dead. Of the million times this past, decade, diversification has died. But it's worth kind of talking a little bit about because it is weird. And it is something that a lot of people are not having fun with, to put it mildly. So just again, to put some quick numbers around it, using the S&P 500 and 5-year treasuries, the S&P 500, again, Alex, over calendar years, it's been down 26 out of the 97 calendar years. 5-year treasuries, it was down 12 out of 97 calendar years. And there's only been 3 occasions where both were down at the same point in time or over that same year. So 1932, 1969, and then 2022, obviously. So it is really rare. But, it's worth considering that stocks and bonds are pretty darn uncorrelated. They move independently of each other effectively. So, over the total time period, 26 to 22, the correlation was about as close to zero as you can get. It was 0.06. So effectively independently, but even more recently, since 2020, so these past 3 years, the correlation is only about 0.1, still really, really low.
What does that mean, Bob? Just so people...
Yeah, absolutely. So correlation is just a statistic.
Well, the 0.1, the numbers behind it.
We'll get there, Alex.
Okay.
Correlation is just the statistical measure of, if I tell you one number, how much can you tell me about the other number? What's the relationship between these two data sets? In this case, the returns of stocks and the returns of bonds. So a correlation of 1 means they're perfectly correlated. If I tell you one number, you can tell me the corresponding number in the other data set. -1 just means it's a negative perfect relationship like that. Correlation of 0 means they're not related in any fashion. It's just random numbers to each other effectively. So, as you get closer to 1, the relationship gets tighter and tighter, more and more solid. So a correlation of 0.1, there's nothing there. There's something there, but not much. Alex, it looks like you want to jump in there for a second.
No. You're on a roll.
Well, Bob, we never actually mentioned, but the 5-year treasuries were down 9.4% in 2022.
Yep.
So almost half the
amount
of the S&P.
Half the amount, yep. So another not fun year for those 5-year treasuries this past year. But, what I want to call out is, they're moving independently of each other. So if you were to go through and just say, what's the likelihood that two random independent things with these probabilities, based on what the S&P 500 did and 5-year treasuries did over this time frame, what's the chance, just complete random chance, that they would both be down in the same year? Well, that works out to about a 3.3% chance, which if you turn it into how many years we see, that's about 3 years out of every 97 or out of every 100 years, we would see both the S&P 500 and 5-year treasuries down in the same year. This is our third observation over that time frame. So again, the market's actually being incredibly well behaved for us, which is very, very weird in and of itself, but we're seeing what we expect here.
It just happens to be a +1 standard deviation event, and it happens. I mean, there's a reason for that. Negative
Absolutely.
20, whatever. Well, I forgot the number exactly, but negative 19, was it? Yeah, negative 19 is, is out there. I mean, it's not unexpected, but would you expect that 67% of the time? No, but it could happen.
Yep.
It still happens.
It's something we got to build into at least our mental models as we're thinking about, do I want to be putting my money at risk in the financial markets? Do I want to be in the stock market? How do I want to build out this portfolio and build out my asset allocation?
The other point, and I remember in our huddle up previously, we did talk about it, but okay, I think this is just conjecture on my part, right? In the morning as I've been working from home, I do watch like CNBC in the morning because I just like the game. I'm not necessarily looking at it for any insight. I just like I love the markets, right? I just love listening to it. And I think there's just this overwhelming sort of news about like the select group of stocks, right? The Alphabet, the Meta, Alphabet and Meta changed their name, so they're throwing me off. Apple, whatever, right? And you're looking at those, and those are down like 60%, 70%. It's like crazy numbers like that. At least at some point, maybe they've gone up a little bit more since then. So it kind of it contributes to that negativity. And you had mentioned is diversification dead from bonds. There's another reason you diversify, right? From specific company risk. And the reality is I'll take a negative 19% any day versus owning Facebook for the year. That kind of thing.
Absolutely. Of the FANG stocks, which is what a lot of what gets talked about, again, the Russell 3000, so the total U.S. stock market, let's put that benchmark on there, down about 19, a little more than 19. The best performer out of that group is Apple. And over 2022, it was down 26.4. That was the best of the FANG stocks. The worst, which Alex called out, Facebook, ended the year down 64, a little more than 64% on that year.
Now, the only thing I would say, Bob, someone could say, yeah, but I've owned it for 5 years, and that beats an 8% return annually that you would have had in the Russell, 3000. Maybe, I don't know.
Maybe.
You know what I mean? If
So.
you drop 60, 70% 1 year, that takes a bite.
Well.
That takes a huge bite.
Those stocks have done really well over the past, call it 5 years or whatever you want. I don't know where it falls out, but if you could at the beginning of those 5 years be able to confidently say, hey, here's what my return on, Netflix is going to be. Cool. Great.
Bill Miller's calling.
Yeah. We would not be having this conversation. You would be on your private island in the Caribbean somewhere, not talking to anyone. But unfortunately, we can't do that. We can't make those predictions. So, what we have to do is kind of take the market as it is and make
Now,
the best of what we can.
now, Bob, we're sort of reading here, previous year's returns, and somebody could kind of say to themselves, well, all right, great. You can read a newspaper. You can
Yep.
put things down on a paper and write notes and tell me what I already know, right? Kind of, maybe.
Yep.
What about going forward, Bob? What about going forward? That's what I need to know.
Absolutely. Well, let me get my crystal ball here. But I think there's some really important stuff to be taken away here in terms of, thinking about what this means going forward. So one is, well, now we have one more year in our data set. Now we can use this information to give us more of an idea of what the market will look like going forward. We got one more year in our average returns. We got one more year in all of these types of numbers. The other thing we want to be thinking about is, how is this impacting myself? We've seen, some pretty wild market swings in the past, call it 3 years. What new information has that given you about yourself in terms of your risk tolerance?
Oh, that's a good angle.
How
very
did
good.
this make you feel? And how did this change you? One of the ways I always think about this is, we're always finding out new information. I want to look at, going back to the tech boom, or the tech crash, I should say. That was, a couple years where it was just kind of not horrific returns in any one year, but a couple of years of pretty crummy returns. That is one sort of way the market can crash. How did you feel about that if you were an investor in that period? Go back to 2008. That was a very sharp, very short crash. How did that make you feel? Did you feel differently there? Now we've got 2022, which is kind of, hopefully will kind of be in that same kind of 2008 type of mental model, where it was very short, very sharp, with a pretty solid rebound after the fact. I can't guarantee that, obviously. Hopefully we see something like that. But you want to be thinking through, how did those make you feel? Would I be able to deal with that? What did I do during those time periods? And that gives you some really, really good information about your own level of risk tolerance. Both
You almost need to, though, record yourself talking into something, because 5 years from now, I think that's going to decay, or start journaling your thoughts or something like that. Wade, because I know you're big into the interest rate stuff and things like that. And you may know this better, and this is a cold question. We didn't rehearse this one, but something I've heard, not that we rehearse the others, Bob is just like a fountain of information. How about the argument? Yeah, but rates are rising and stocks don't go up when rates rise. Sorry, I couldn't say that properly. I mean, directionally, I know the answer, but what do you guys think? What are your thoughts around that?
I don't know. We're 3 weeks into the January 2023 now, and I'm working on the book updates. And already since January 1st, interest rates have gone down quite a bit. And it speaks.
It's not just a continual rise. Yeah. Good point.
It's a good start to the year too. But it's really just hard to know what to expect, and whether interest rates is one of the hardest variables to try to predict, other than today's interest rate is your best estimate of what future interest rates will be. So there's not a whole lot you can go beyond that sort of statement.
And Bob, do you place a lot of credence in stocks are not going to be able to go up until the rates stop going up?
No, I don't. I kind of come back to what Wade just said there about how, the best predictor of future interest rates are today's interest rates. It's a really bad predictor, but it's the best one we got. So, we start from there. And one of the really important things to think about in terms of forecasting future expected returns is that your interest rates, what the interest rate environment, that's part of how expected returns get built out. That's part of the, depending on exactly how you do it, that's part of the risk-free rate. That's part of, the different risk premia that go into building out your expectations of future returns. The other one is you can even just look at periods when interest rates have been rising. Just look at stock market returns in the 80s. That was not a, yeah, that was not a period where, the stock market as a whole was doing particularly poorly. I don't remember the exact numbers off the top of my head, but, there's a reason, we have, like Wall Street and all those different types of movies because the market was doing phenomenally well back then.
I want to say it again. This is top of my head stuff, but the bull market the longest running bull market that ended like with the .com crash and all that, I think started in I want to say 82,
or very early 80s, yeah.
Or even earlier than that. Okay,
I don't know if it was earlier than that, but kind of that type of time.
Oh yeah, I think it was around 82, and interest rates weren't low.
Nope. So
the beginning of the boom. But before we get too far beyond these points, too, just Bob, you may want to mention the value versus growth aspect, which is an area that value had been hit hard for a long time and had a good year in 2022.
Yeah, no, we definitely want to talk about this one because it is something that is really important to think about.
You want to frame that just so people understand what we're getting at, because Wade does bring up a good point.
No, absolutely. So, actually this gets back into that conversation about, as I mentioned, the different risk premia that go into building out expected returns. So there's a lot of different risk dimensions. Value versus growth is one of the really common ones. So, value stocks versus growth stocks. It's really kind of, growth stocks are those high flyers that everyone's really, really excited about. They have to put it into kind of market type of terms, they have what's called a high price to book, or some other metric. So
they're expensive.
They're expensive. The market's willing to pay a lot for, whatever the accountants say this thing is worth. On the other hand, we have value stocks, which are not expensive. The market's not willing to pay as much for whatever the accountants say this company is worth. Those are your capital intensive manufacturing type of companies generally. Whereas growth is, those FANG stocks, all those really high flying tech stocks. And, for a while now, growth stocks have been beating value stocks. And, we're starting to see that turn around. And I should say one of the reasons we're talking about this is because, when you start kind of breaking it down, value stocks, we expect to have a higher expected return or have a higher return than growth stocks over the long term. And as I just said, growth stocks have been doing real well for a long time now. So a lot of people have been kind of having that conversation. Is that, one, still true? Is that something I can rely on going forward? So, it's nice to see this kind of coming around. Definitely, obviously, we have no way of predicting if this will continue or not, but, value, over the past year has done incredibly well in the U.S.
Well, this is on a relative basis because it's been negative.
It's all been negative.
But relative to growth.
Relative to growth, they've done well. But, to put it in perspective, large value and small value in the U.S. stock market, so large value stocks and small value stocks, those were the two best performing asset classes in the U.S. It feels weird to say, but at -7.5% and -14.5% respectively on the year. On the other hand, the two worst were small growth, so small growth companies, and large growth companies. They were down 26 1/3 and a little more than 29.1% respectively themselves. So if we're looking at them on a relative basis, the value premium in the U.S. So the returns of the Russell 3000 value. So basically all the value stocks out there minus the returns of the growth stocks out there in the U.S. It was up almost 21%. Value beat growth by almost 21% over the
21 percentage points.
Percentage points. Yes, excuse me. In developed international, the value premium was a little more than 17 percentage points. And even in emerging markets, the value premium was up a little more than 8.1%. So, it had a really, really great year. Again, we have no way of guaranteeing or anything like that is as we always do when we talk about these types of numbers. But it's nice to see that everything's kind of working appropriately here.
I think what I would add is I think this is important, and from the vantage point of how you interpret this. Mm-hmm. Somebody could be listening to it saying, well, yeah, it's obvious. The frothiness is coming off the market. Look at the returns of the FANGs. There's a secular rotation going away from growth and into value. And value is represented by these industrials. And the industrials are the ones that have been hit hard from COVID, so they've already been prepping for it, where all the technology companies are right now having to reassess their capital structure, have these mass layoffs. And so it's obvious what's going to happen. I think it's going to continue for a while longer. I'm saying these things. I'm almost trying to parrot what I hear on TV, right?
Oh, absolutely.
It's easy to say this after the fact and all of this. And, I can see this rotation continuing because the infrastructure is back in play and the farm equipment and the railroads and blah, 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 blah. I don't know. Not so fast. If you ask me, they don't know that. They're sort of backing into a story here, large. I mean, maybe they're right, but who knows is what I would say. Bob, but Wade, what are your thoughts on that, Wade? Because I think everyone knows where where Bob and I stand on these kind of statements that are made about secular rotation and this and that. What goes through your head when you start hearing people talk about the rotation back into value?
I just try to tune it out. I'm not.
For those of you who are not watching the video of this, we have this up on YouTube. But Wade just gave the most withering look I've ever seen him give. So
yeah. Wade doesn't. Wade doesn't. You see, I get dirty. Wade doesn't get dirty. He's above it. He's above the fray. What was your Bill Belichick response, Wade, again?
I do not demean myself.
Yeah, I don't mind.
I'm a cord.
No, you ignore it, right? You just
channels anyway.
Huh?
I can't. I don't have cable TV anyway to watch that stuff.
You don't? Wait, this is its own podcast in and of itself. Really? Well, you cut the cord, or you just don't listen to anything?
I don't have cable. I don't have.
Yeah, you don't need cable anymore. Although that's a completely different.
I got Hulu and Netflix and
okay,
Amazon
all right, that's
Prime,
fine.
So
all right. I'm a holdout. Part of it is I'm just lazy to call it in and stuff like that. But that's me. That's on me, not on you. But effectively, what you're hearing is you ignore that stuff. You don't pay any attention to, oh my goodness, and how I'm going to incorporate this sector rotation into my capital markets assumptions.
That's right. Yes.
Okay. Fair enough. That's I agreed. I just wanted to point that out, that we people don't really think about stuff. The other stuff about this value premium and stuff like that, it's a risk-based story. Well, that's, we can have a conversation about that, right? But that's where I'm tilting towards. But what about the folks that will say, well, if you look at the Bollinger Bands, or if you look at the 200-day moving average, or if you look at this, it's right now above a certain amount, and until it hits this resistance, value is going to continue to outperform growth. These kind of chartists, if you will. What's your take on that, Bob? When people come at you with those kind of things about how much longer will value beat growth? We all know the answer. We just want to know how you word it. I just want to know how you word it.
This is one, don't say anything if you don't have anything nice to say, type of situations. There's no value there. There's nothing useful there. All of that information is already in the market. Everyone knows what the price has done previously. That's already in those prices. What matters is what happens next. What matters is that next piece of news, and not just that next piece of news, how that next piece of news squares with what the market expected to happen. Because they could very easily get a great piece of news, but if it wasn't as great as the market expected, the market could still come down. It has nothing to do with the previous price movements.
So that's a way of saying these charts and all of these things.
They're useless. I'll say it. Yeah.
Doesn't matter because they're looking back. Okay.
Right.
Can you still make a good case that, look, there's a value premium over the long term that it makes worth shifting away from a market portfolio?
Absolutely. I mean, it is a risk-based story, so you have to decide if that risk, the specific context of that risk makes sense for you if you like that particular risk trade-off. But yes, there is absolutely no reason to believe that the value premium has gone away or is broken or doesn't work anymore. Or, pick your terminology. In fact, you can make a pretty strong case that the rationale behind the value premium is even stronger than it was previously, because the spreads between value and growth, how expensive or cheap they are.
That's where I was going with this. This is an important point, and I wanted you to unpack there.
Yeah, the spreads, they weren't as good as they were, or weren't as, I shouldn't say good.
And what do you mean by spreads? Just because I know what you mean, but just the spreads. Yeah. What does it mean?
So the spread is kind of I guess you could say how much the market is willing to pay more for a growth company versus a value company. Those are just phenomenally massive right now in a historical context. So what that's saying is, and again, I want to be very clear, there's no guarantees on any of this type of stuff. It is a risk-based story. Markets are noisy.
We're not predicting. I get it. We're not predicting.
But what I would say is, based on the size of these spreads, I would expect the return, my expected return for the value premium, would be higher now than it's been in the past. Now, obviously, the value premium was positive in 2022, so my expected return in coming into 2022 would be a little higher than it is now, but it's still really friggin' high.
Okay, so if I said it like this, historically, and now I'm making these numbers up for the audience listening in, if historically the PE on growth stocks has been 25, that means that you're willing to pay $25 for $1 worth of earnings, right? Mm-hmm. So historically, the PE for growth stocks has been 25. It hasn't. I'm using this as an example.
Just round numbers.
Yeah, and the PE for value stocks historically has been 15, to say a number, where you're willing to pay $15 for $1 of earnings. Hence, there's a premium to growth stocks because they're more expensive. So that spread is 10. A PE of 10, a PE of 25 versus a PE of 15. Right? Let's just say that's the historical spread. You're saying that historical spread has not compressed in the slightest, even though value has outperformed. So value stocks haven't technically got it.
A little bit, but
you know what I'm saying? Yeah. Value stocks haven't become more expensive on a PE level. In fact,
so we moved from, say the historical average spread on that PE. And again, this is just round numbers examples. This is entirely wrong. But, if we were to say that was 10 on average historically, prior to 2022, say it was 17, now we'd be at like 16. So it's come up or it's come down a little bit, but it's still massively bigger than we would expect to see historically, or we have seen historically.
And that's important. And the way I see that is, again, no forecasting here, but okay, so just because value has outperformed growth for, let's say, 2 years, even if it's 3 years, just to say 3 years, if that spread is still significant, that seems interesting to me.
Yes, absolutely.
I don't know how I can say that way without saying I'm all in. I'm not all in, but it's one of those
it's one of those. If 10 years ago you liked the value premium,
you love it now.
You should love it now. So it's the same logic. It's just the numbers have shifted around such that the expected return of that value premium is probably higher than it was in the past.
Perfect, and that's a good ending point here. Wade, since we socialized it earlier, the dashboard, and just to bring this episode to a close, what do we do with all this? How can we use all of this information, in terms of if I'm a total return investor, to make sense of potential distribution strategies? And I'm, teeing you up to kind of pique everyone's interest for the next week's podcast.
Mm-hmm. Well, we didn't talk about inflation yet, but that's going to be an important variable as well.
Sorry.
We should probably bring up the inflation.
Yeah, talk about it. Yeah. Sorry, I was using my 50-minute limit, but we can go longer.
Yeah, right. We got a bonus length episode today.
Yeah. Go on. Hit up inflation. Knock it out.
Sure. Okay, we'll touch on inflation. So obviously, inflation has been a really, really big topic, for the past year plus, however long it's been. I forget exactly off the top of my head here, but been a while. But we haven't heard quite as much about it over, especially the back half of the year, especially the fourth quarter, and that's because inflation has been incredibly low, over the past few months. So the annual inflation over 2022, again, U.S. CPI type inflation numbers, the annual inflation was about 6.5%. To put that in context, the monthly inflation, last month was negative 0.1%. So we had a minuscule amount of deflation, actually, which, deflation in the long term, that's a big, scary thing. Month to month, that's not unusual. So just to put that out there. But the last I'm sorry, Wade, I think you're muted there. But the last kind of big number change that we saw was actually all the way back in June, when inflation jumped 1.3% that month. But ever since then, it's been kind of low decimal type of numbers, 0.1, 0.2, 0.3. I think we had a month or two at 0.4. So pretty small amounts. That 6.5, the bulk of that came the first half or so of the year. And again, getting back to Alex, your point there about, cool, we can all read the Bureau of Labor Statistics press releases and get those numbers ourselves. What we care about is, what does this tell us about the future? What's going to happen next? And that's some really, really interesting stuff. One of the ways, Wade, I know you do the same thing I do here on, is when we're looking at future inflation, what we actually can do is we can use the market to predict what inflation is going to look like over time. And what we do is we basically just subtract the TIPS yield from the nominal treasury yield. And the difference there, that's how much the market is expecting inflation to be. That's how much someone is willing to pay to get rid of inflation. They're still going to get that treasury return, just in a real fashion, an inflation adjusted fashion. Mm-hmm. And what we're seeing is numbers. What's that?
I was just looking at those numbers on January 1st, and over the next 5 years, it's 2.3%. That's kind of the built-in expected average inflation rate. And that's actually the same as over the next 30 years too. So
yep.
We're looking at long-term expectations of 2.3% inflation, which is below historical numbers.
Yeah, in fact, it's even gone down since then. So Wade, you were looking at January 1 numbers. I pulled the numbers. We're recording this on Thursday. So the Wednesday numbers, that 5 year was at 2.09%. So over the next 5 years.
So me being a bit of a, just to stir the pot, why doesn't the Fed then say, okay, well, it seems controlled. If the expected 2 years, the same as expected 30 at 2.3, that's a good number. That's within my mandate. Let me stop raising rates. Why doesn't Powell care about that?
Well, I guess you'd have to know what those expectations may involve people believing
that Powell will
do. Policy will be, and if the Fed did something different, that's the kind of shock that Bob's talking about, where suddenly the expectations need to change.
That's the perfect answer. I just wanted to I'm trying to play the role of somebody listening, saying, well, isn't the Fed reading this? Why don't they just stop? And your answer is, well, it's kind of the expectation is that the Fed will continue, hence that's why it's this. I know that that I know, kind of thing.
Exactly.
I just wanted to point out
the other thing to call out is
the chess game.
The other piece of information that I think is worth calling out here is not just the Fed movements, but actually the unemployment rate. We're seeing really, really low unemployment numbers, which is normally something that kind of drives up inflation. More people have jobs. Companies have to pay those people more to get them to hire those people. So there's more money just kind of circulating around the economy, which tends to push up those inflation type of numbers. So that's also in the mix there as well. So we're, potentially looking at pretty darn low inflation numbers over both the short term, Right now we're looking at a 1-year inflation number from the market's expectation about 1.8. All the way out to 30-year is 2.1 something. Putting that into context, the historical average annual inflation was about 2.8, 2.9%. So we're seeing below average inflation, over the long term here.
Yeah, but Bob, I go to the store right now and eggs are $7. So you can tell me all of this.
This is change here. This is change starting from.
I'm not. It's not me talking.
Yep. Yeah, absolutely.
People listen to it and say, "Bob, these are just numbers. You're crazy. Eggs are at $7."
Yes. We're starting from the point where we are right now. Just like if we were to look back at the 1950s, there's no more penny candy stores. I don't know if that was the 1950s or not, but earlier on, there's no penny candy stores anymore.
I think another way to maybe say that is what's done is done. The inflation that has occurred has occurred.
Yes.
But
and
going
very
forward,
emphatically, as I mentioned, long-term inflation or long-term deflation is scary and economy wrecking. We don't want to go backwards. What we're looking at is what happens moving forward.
Yeah, 2022 is a tough year though, but interest rates are higher now. Inflation is higher, but ultimately expected to come back under control as long as things as progress as people expect them to. And that does lay a foundation for better retirement spending numbers than before. And if you've used our funded ratio tool, just the rise in the interest rate you're able to use, and that does help dramatically. So now, as I'm getting to the stage of being closer to putting the finishing touches on a revised edition of the Retirement Planning Guidebook, it looks better. The case studies look better. Having higher interest rates helps dramatically to improve the funded status of a retirement plan. And so that is at least one optimistic note too.
As long as it doesn't have corresponding inflation with it.
Right. So the other thing we call out off that point, if you've done the Retirement Income Challenge in the past with the Retirement Researcher and you want to get a better result on your funded ratio, now's the time to sign up for another one. So.
And then next week we'll go into the dashboard. Right, that kind of extends the good news of the current environment. So, all right, everyone. Thank you for listening, and we'll catch you next week.
Yes, thanks, and thank you, Bob.
Thanks, guys. It was a lot of fun.